This is a delivery receipt, issued by the Shanghai Gold Exchange on January 24, 2026, at 3:47 p.m. local time. The receipt confirms transfer of 1 kilogram of gold, approximately 32.15 troy ounces, from SGE vault inventory to a private buyer in Shenzhen. Standard transaction, routine paperwork, the kind of document processed thousands of times daily on the world's largest physical gold exchange, except for one detail. At the bottom of the receipt, in small characters that most buyers never notice, a stamp appears in red ink. The characters translate roughly as, "Delivery subject to extended settlement, inventory allocation pending." Extended settlement, inventory allocation pending. On an exchange that has never, in its 24-year history, failed to deliver gold on demand. The Shanghai Gold Exchange doesn't trade paper. That's the entire point of its existence. When you buy gold on the SGE, gold arrives in your account. Not a claim, not a promise. Physical metal, transferred from exchange vaults to your allocated storage. The exchange was designed specifically to avoid the paper leverage structures that define Western gold markets. And now, for the first time since its founding in 2002, the SGE cannot deliver on demand. The largest physical gold market in the world has run out of gold. Not temporarily, not due to logistics. The vaults are empty. The metal that was supposed to be there isn't, and the implications of that absence are cascading through global markets in ways that will reshape how the world prices, trades, and thinks about gold for decades to come. Here's what they're not telling you. The Shanghai Gold Exchange publishes weekly vault inventory reports, a transparency measure that Western exchanges have resisted implementing. These reports show exactly how much gold sits in SGE-approved vaults, available for delivery against exchange transactions. On January 3, 2026, SGE vault inventory stood at 1,847 metric tons, a healthy figure, approximately 18 months of average weekly withdrawal volume. On January 10th, 1,612 tons. On January 17th, 1,203 tons. On January 24th, 447 tons. In 21 days, 1,400 metric tons of gold, $120 billion at current prices, vanished from Shanghai vaults. Not traded, not sold, withdrawn. Physically removed by owners who decided they'd rather hold their metal elsewhere than leave it in exchange custody. The withdrawal rate wasn't gradual, it accelerated. The first week saw 235 tons leave. The second week, 409 tons. The third week, 756 tons. Each week, withdrawal volume roughly doubled as the pattern became visible and participants rushed to secure their metal before it disappeared. By January 27th, when the SGE issued its first ever delivery delay notification, vault inventory had fallen below 200 tons, against outstanding delivery obligations of 340 tons. The math was simple and brutal. More gold was owed than existed. The exchange didn't default, not technically. It invoked emergency provisions allowing extended settlement periods during extraordinary market conditions. Buyers who expected same-day delivery were informed their gold would arrive within 15 business days. Maybe. 15 business days. On an exchange built specifically to guarantee immediate physical delivery. The SGE's competitive advantage over COMEX and LBMA was instantaneous settlement in metal. That advantage is gone. The mechanism behind the withdrawal wave is not mysterious. It's documented in exchange filings, visible in trade flow data, and confirmed by sources inside Chinese financial institutions. What happened in Shanghai was not a bank run, it was something more calculated. A strategic repositioning by entities that saw the LBMA settlement failures coming and decided to secure their gold before the contagion spread. At 9:15 a.m. Beijing time on January 22nd, 5 days before the SGE delivery delays began, the People's Bank of China issued an internal directive to state-owned enterprises and sovereign wealth vehicles. The directive, portions of which have been shared with international analysts, instructed these entities to ensure physical custody of strategic metal holdings through direct vault possession rather than exchange-based storage. The PBOC told state entities to withdraw their gold from the SGE, not sell it, not trade it, remove it from exchange vaults and take direct possession. The directive went to entities holding an estimated 800 to 900 tons of gold through SGE accounts. Within 72 hours, withdrawal requests flooded the exchange. The vaults couldn't process the volume. The inventory collapsed. This is where the lie becomes unsustainable. The Shanghai Gold Exchange was supposed to be different. It was built as a counterweight to Western paper markets, a venue where physical delivery was guaranteed, where leverage was prohibited, where gold meant gold rather than a contractual claim. For 24 years, the SGE delivered on that promise. Literally delivered. Every transaction settled in metal. The exchange became the reference point for physical gold pricing globally. When Shanghai premiums diverged from London or New York, analysts treated Shanghai as the truth and Western markets as the distortion. Now Shanghai can't deliver either. The paper versus physical distinction that separated East from West has collapsed into a single reality. There isn't enough gold. Not in London, where LBMA settlement failures triggered the crisis. Not in New York, where COMEX registered inventory sits at multi-year lows. And now, not in Shanghai, where the world's most reliable physical market has exhausted its reserves. The divergence isn't between paper and physical anymore. It's between claims of any kind and actual metal in hand. The premium for immediate physical delivery has exploded accordingly. In Hong Kong, dealers are quoting $4,100 per ounce for gold bars available same day, a $780 premium over the benchmark London spot price. In Singapore, $4,230. In Dubai, $4,340. Each market prices the scarcity of what can actually be delivered versus the fiction of what's theoretically available. The Shanghai spot price, SGE's benchmark that once reflected true physical value, has become meaningless. The exchange can quote any price it wants. If the metal doesn't exist to deliver at that price, the quote is academic. What matters now is the delivery price, the price that clears actual transactions where metal changes hands. That price is 23 to 31% above official benchmarks and climbing. When institutions do what they're doing now, they're not managing positions. They're abandoning a system they no longer trust. The PBOC's directive to withdraw from the SGE wasn't about the SGE specifically. It was about counterparty risk in all exchange-based storage systems. The Chinese central bank looked at what happened in London, the settlement failures, the paper-physical divergence, the scramble for actual metal, and concluded that exchange custody of any kind carries risks that direct possession does not. Their response was immediate and comprehensive. Get our gold out of all exchanges, including our own. The irony is precise. China built the SGE to escape Western paper market vulnerabilities. Now China is escaping the SGE using the same logic. When delivery becomes uncertain, possession becomes paramount. The withdrawal wave from Shanghai isn't limited to state entities. Private Chinese buyers, wealthy individuals, family offices, corporate treasuries, are following the PBOC's lead. If the central bank doesn't trust exchange storage, why should anyone else? Private vault facilities in mainland China report waiting lists exceeding 3 months. Companies that provide secure storage for high net worth individuals are turning away new clients. The infrastructure for private gold custody, built for a niche market, cannot scale to accommodate mass institutional demand. The gold that leaves the SGE doesn't re-enter any exchange system. It disappears into private vaults, safe deposit facilities, and, according to reports from Chinese security firms, residential storage at volumes that create their own risks. Less than 200 tons remain in SGE vaults against a market that normally consumes 50 to 60 tons weekly. At current withdrawal rates, the exchange depletes entirely within 30 days. At accelerated rates, which the pattern suggests, depletion could occur within 2 weeks. The countdown is specific because the inventory reports are public. Every Thursday, the SGE publishes updated vault figures. Every Thursday, the world will watch the number decline until it reaches 0. What happens when the number reaches 0? The SGE has never faced this scenario. There is no playbook, no precedent, no emergency protocol designed for an exchange that exists specifically to guarantee physical delivery, discovering it has no physical metal to deliver. The options are all bad. Suspend trading entirely, confirming the crisis and triggering panic globally. Allow trading to continue with indefinite delivery delays, destroying the exchange's credibility permanently. Source metal from international markets at premium prices, accepting losses that could exceed the exchange's capital reserves. None of these options restore the SGE's fundamental value proposition, reliable physical delivery. That proposition is already destroyed. What remains is damage control. While Shanghai empties, the cascade spreads. The PBOC's withdrawal directive created immediate pressure on SGE inventory, but it also created secondary pressure on every other gold market connected to Chinese demand. China imports approximately 1,400 tons of gold annually, more than 40% of global mine production. Those imports flow through refiners in Switzerland, vault facilities in London, and logistics networks that span continents. Every participant in that supply chain is now recalculating. Swiss refiners report that Chinese orders have shifted from delivery to SGE vault to delivery to private Chinese facility. The metal still flows to China, but it no longer enters exchange inventory. It goes directly to end users who have decided that exchange custody is unacceptable. The refiners don't care where the metal goes. They care about getting paid. But the shift in delivery instructions has profound implications for global inventory. Gold that previously recycled through the SGE, sold by one party, bought by another, remaining in exchange vaults throughout, now exits the system entirely. Each transaction removes metal from available float. London, already stressed by its own settlement failures, faces additional pressure as Chinese buyers accelerate direct shipments that bypass the SGE. LBMA vaults, depleted by the recent delivery demands, now serve as transit points for metal headed to Asia, metal that passes through but doesn't stay. The one-way flow intensifies. Metal moves east. Western inventory declines. The paper claims in London multiply against a shrinking physical base. COMEX registered inventory fell below 14 million ounces this week, the lowest level since 2015. The exchange maintains eligible inventory, metal in vaults but not available for delivery, of approximately 18 million additional ounces. But eligible inventory can't settle futures contracts, only registered counts. The three major gold exchanges, LBMA, COMEX, SGE, are depleting simultaneously. The mechanisms differ. Settlement failures in London, withdrawal waves in Shanghai, quiet inventory decline in New York. The outcome converges. Physical gold is becoming scarce in institutional markets at exactly the moment demand is surging. The BRICS nations announced emergency consultations on precious metals market stability for February 3rd. The meeting, convened at China's request, will include central bank representatives from all member states. The agenda, according to preliminary communications, includes mechanisms for ensuring physical gold availability for member nation reserve requirements. Translation: BRICS nations are preparing a coordinated response to the supply crisis. That response may include pooled reserves, preferential sourcing arrangements, or the BRICS gold-backed settlement mechanism's accelerated deployment. Whatever form the response takes, it will prioritize BRICS access to physical gold over non-member access. The remaining available supply will flow to the nations organizing to secure it, away from Western markets already struggling to maintain delivery capability. This is what a system looks like when it runs out of time. For decades, the gold market operated on an assumption so fundamental it was never questioned. There's always more gold available somewhere. If London runs short, source from Zurich. If Zurich tightens, pull from New York. If New York depletes, Shanghai has plenty. The assumption failed simultaneously across all major markets. There is no backup vault. There is no reserve inventory. There is no lender of last resort for physical metal. The gold that exists, roughly 212,000 tons mined throughout human history, is distributed across central bank reserves, private holdings, jewelry, industrial applications, and market float. The float available for trading is perhaps 15,000 to 20,000 tons globally. Against that float, paper claims on LBMA, COMEX, and formerly the SGE total an estimated 25,000 to 30,000 tons. The math never worked. It only appeared to work because claims rarely converted to metal simultaneously. The leverage was hidden by velocity. The same ounce counted multiple times as it moved between counterparties, each holder believing they owned it exclusively. The Shanghai crisis reveals what the math always said. There isn't enough gold to satisfy the claims. There was never enough. The system functioned on faith that conversion would remain rare. Conversion is no longer rare. It's epidemic. From London settlement failures to Shanghai's empty vaults, holders are converting paper to metal at rates the system cannot sustain. The trap has no exit that doesn't involve repricing. When supply is fixed and demand exceeds supply, prices rise until demand and supply equilibrate. This is not theory. This is the mechanism that governs every scarce resource. Gold's paper price, the benchmark quotes from exchanges that can no longer deliver, has risen 23% since the crisis began. But the paper price increasingly reflects trading in instruments disconnected from physical reality. The physical price, what buyers actually pay for metal they actually receive, has risen 47%. The gap represents the market's assessment of paper's credibility. As credibility declines, the gap widens. If paper and physical fully diverge, if the benchmark prices become pure fiction, untethered to any delivery capability, gold pricing will bifurcate permanently. There will be a paper gold market, trading derivatives and ETF shares and unallocated claims. There will be a physical gold market, trading actual metal at whatever price clears. The physical market will be real. The paper market will be a game. The transition between these states is already underway. Shanghai's empty vaults mark a milestone in that transition. The world's most reliable physical exchange can no longer perform its defining function. The benchmark that Western analysts trusted as true price discovery has become just another set of quotes detached from deliverable supply. Those who understood the supply dynamics positioned accordingly. Since January 15th, private vault storage bookings in non-exchange facilities have exceeded all of 2025's total volume. The wealthy, the sophisticated, the institutionally connected, they're not debating whether physical gold matters. They're securing it while security is still possible. The mining companies that produce new supply are facing pressure from all directions. China's state-owned gold producers have been ordered to prioritize domestic delivery over export contracts. Russian production flows exclusively to BRICS-aligned markets. South African output, approximately 100 tons annually, is being courted by competing buyers offering premiums that would have seemed absurd 6 months ago. New mine supply of approximately 3,500 tons annually cannot fill a 25,000-ton paper claim structure. The supply deficit isn't marginal, it's structural. It's permanent until either paper claims are extinguished or prices rise high enough to destroy demand. Prices have not yet risen high enough. The premium market, $4,100 in Hong Kong, $4,340 in Dubai, suggests where equilibrium might eventually settle. But even those premiums assume sellers willing to sell. As the crisis deepens, sellers become scarcer. Why sell an asset appreciating daily for currency depreciating daily? The holding mentality transforms markets. When owners refuse to sell, price discovery breaks down. The last transaction price becomes stale. The next transaction, whenever it occurs, happens at whatever the buyer is willing to pay, unconstrained by historical reference. This is how gold behaved in past monetary crises. In Weimar Germany, gold transactions occurred at prices that changed hourly, divorced from any official quote. In Zimbabwe, gold traded informally at multiples of the paper price. In Venezuela today, physical gold commands premiums exceeding 50% over international benchmarks. The pattern repeats because the mechanism repeats. Paper currency loses credibility. Gold gains demand. Supply proves insufficient. Prices discover new levels that seemed impossible before the crisis, but seem obvious afterward. Reality asserts itself through empty vaults and unmet delivery obligations. The theoretical arguments about paper versus physical, the debates that have occupied gold analysts for decades, resolve into a single data point. The Shanghai Gold Exchange, the world's largest physical market, has no gold to deliver. The debate is over. The resolution is in the inventory reports. The SGE has less than 200 tons against obligations exceeding 340 tons. The math doesn't lie. What remains is response. Not response to arguments or theories or predictions, response to fact. The fact is that physical gold is now scarce at institutional scale. The fact is that major exchanges cannot deliver what they've promised. The fact is that the paper-physical gap now exceeds 25% and is widening. These facts existed before Shanghai ran dry. They became undeniable when Shanghai ran dry. The difference between existing and undeniable is the difference between information for specialists and reality for everyone. Everyone now knows. The SGE inventory figures are public. The Hong Kong premiums are public. The delivery delays are announced and documented. The information that was once confined to those who sought it is now visible to anyone who looks. The window for positioning at paper prices is closing. Not metaphorically, literally. When exchanges can't deliver, exchange prices become irrelevant. The relevant price is whatever physical sellers demand from physical buyers. That price is $4,100 in Hong Kong this morning. It will be higher tomorrow. Shanghai didn't run out of gold because of a conspiracy or a failure or an accident. Shanghai ran out of gold because owners decided to own it rather than leave it in someone else's custody. That decision, multiplied by thousands of participants, emptied vaults that took decades to fill. The decision won't reverse. The owners who withdrew their gold won't return it to exchange custody. The trust that made exchange storage acceptable has been broken. Broken trust doesn't heal quickly, if it heals at all. The 2026 supply crisis just got real, not because conditions changed, but because the reality that always existed became visible. The vaults were always leveraged. The claims always exceeded metal. The system always depended on faith that conversion would stay rare. The faith is gone. The conversions have begun. The vaults are empty. And gold, physical gold, the kind you can hold, the kind that doesn't depend on counterparties or exchanges or delivery schedules, just became the scarcest asset in the global financial system. The scarcity is priced in Hong Kong at $4,100. It's priced in Dubai at $4,340. It's priced in Singapore at $4,230. It's not priced yet on the paper exchanges that can't deliver, but it will be. The paper has to catch up to the physical, or the paper becomes worthless. That convergence, paper rising to meet physical, or paper collapsing entirely, is the next chapter of this crisis. Shanghai's empty vaults are the prologue. The story is just beginning.